Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets. Yeah, you guessed it, still don't make any sense. After all, the ADP posted, I want to say 67,000 jobs created last month, one of the weakest ADP reports in the last 10 years. And the stock market says that's bullish. That's bullish for stocks. That's higher interest rates. So you have weak payroll growth, and somehow mysteriously that's good. You know, there is a point in any economy where you reach effectively 100% employment. I know somebody saying, well, my spouse is out of work, my kids are out of work, I got relatives, friends. Yeah, I get that. There will never, ever be a point where every person who can possibly work is working. If there is, even if that did happen, there is a point where you run out of people and that's it. It's like we can't grow anymore because we're at 100%. It's like putting your car at red line. I mean, you just can't go any further. It goes as fast as it can, and that's it. But yet people still think interest rates need to go up. And yet I could show you a chart over the last, say, 40 years from 1980 to now of interest rates that have gone, I'm going to always get this wrong, down. And people say, but they've got to go up. Why? Well, because they've gone down for 40 years. Well, you said that 30 years ago. Yeah, but they've got to go up now. But you said that 20 years ago. Yeah, but this time they have to go up. But you said that last year. Why do interest rates have to go up? Because if interest rates were 10%, would you run out and buy a new car, a home, an airplane, take a second on your home? No. Nobody would. I mean, some people would have to. I mean, if you're relocated or your car blew apart, I mean, you probably go buy used before you bought new. But no, that doesn't spur inflation. Higher interest rates are inflationary by design of what high interest rates are. That's why you see inflation during periods of high interest rates and no inflation or very low inflation during periods of low interest rates. But yet people still think, well, yeah, but after 40 years, don't you think interest rates have to go up? No, interest rates have to continue to go down in a debt-based economy to spur continued lending demand. That's how it works. You know, there's two ways out. The Fed, you know, why does the Fed have this 2% inflation target? What are they trying to do? Inflate the debt away. Look, they're looking at consumer prices as their gauge, right? As their barometer. Okay, look, is this working or not? It doesn't. You can't. I don't know why the Fed thinks it has to be in consumer prices because that's not inflation. But they're trying to inflate the debt away. That's how you deal with it. So, think about how do you get the economy to grow in a debt-based economy? Well, one, you can either actually have legitimate growth and outgrow your debt, or grow enough where your debt isn't a burden, right? Yeah, maybe your income's growing at 5% a year, but your debt's growing at 4% a year. So I mean that's reasonable. It's a problem when your debt's growing at 10% a year and your income's growing at 5%. That's obviously a significant problem. That is a problem the government has right now. The debt is growing faster than the economy. So one way is you can actually have legitimate economic growth and outgrow the debt. The second is you can inflate it away. So the Fed's decided that 2% is reasonable, that you can handle 2% inflation, because what does that do? It shrinks the debt over time, right? Think about it. Let's say you went out and bought a home today, a $300,000 home. Well, at 2% inflation, that mortgage, say, of $300,000 isn't going to look that bad 30 years from now, right? My father, if he was standing here, he would tell you what the payment was on his first mortgage, and it's almost a laugh. I mean, I think I've always had a car payment that was higher than his mortgage payment. So it's all relative. I think back to high school, and I remember, for those of you who are old enough, one of the popular vehicles when I was in high school in the early to mid 90s was something called a Mitsubishi Mighty Max pickup truck. And those of you know what I'm talking about, like I remember those, and they were cheap, just little pickup trucks that you could go buy. And I remember the commercials, $99.99, right? You get brand new, full warranty Mitsubishi pickup truck. Now they don't make those anymore. In fact, they don't really make mini trucks per se. But how much do pickup trucks cost today? 50, 60 grand or more? It makes that $99.99 look like a really good deal. So you can inflate your debt away. And that's what the Fed's trying to do. But people don't understand. I mean, have you ever thought, why don't we have simple interest loans? Have you ever thought about that? Why do we have fully amortized loans? Who gets paid first? Have you ever thought, like, gee, I got this 30-year mortgage. Who gets paid first? The bank, right? Why does the bank get interest first? Well, why isn't it reversed? Why don't we pay equity first and interest last? Because the bank needs to get their money back, their interest, their profit, right? They don't care. The principal is not the issue. They need to get their profit back, because if they had to wait till the end, let's say it was reversed, right? In the last, say 10 years of your mortgage were just purely interest payments. Of course, people might default by then and say, well, I own the house. You can go after me for the interest payments. Forget that. But that money wouldn't be worth as much. So the banks need to get their money back first. That's why we have fully amortized loans. But you never thought of it that way. It's all because if you can't outgrow it, you got to inflate it away. And it's not working at all. And if, like I said, you look at today's ADP payroll report of 67,000 jobs, which is, it doesn't exactly correlate to the non-farm payroll report coming Friday, but it gives you a good indication. If the ADP report was like 200,000 jobs created, we'd feel like, wow, there's a lot of people getting hired. But at 67,000 jobs, you could be like, whoa, this next report may not be so hot. But at some point, everything comes to an end. Every economic cycle, it all does come to an end. And just think, do unemployed people, do they get loans? The content of this video is provided as educational information only, is not intended to provide investment and other advice. This material is not to be construed as a recommendation or solicitation to buy or sell security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Our own personal capacity opinions expressed in this video that I'm on do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial. So unemployed people, they don't get loans, do they? So how is lower payroll growth inflationary? I don't know. I'm not saying it is, because it's not. But isn't it interesting that the market would think that? The NASDAQ McClellan Summation Index looks like it's flatlining, trying to figure out why stock prices are not going higher. And again, we're looking for a deep plunge in this for it to break down below minus 300 back down here, have a really deep sell-off where the market gets oversold to take some risk back to the portfolios. Of course, at that point, we should be looking at a bull market in bonds, which is outstanding because we're well positioned for disinflation or deflation, which should come. I mean, there's no question about it. Let's take a look at how the hedge funds are positioned. Now, remember, we couldn't look at this Monday like we normally do because of the short week from the holiday week from last week. The Commitment of Traders report comes out on Monday. So I want to thank Hedgopia for being on the ball and getting this out really quick. He didn't waste any time. So I appreciate that he takes the time to put these charts up and to do a write-up. So if you want to go read what he had to write, he's certainly well educated. Anyways, we look at the 10-year Treasury yields. And again, people, hedge funds are short. They still think inflation's coming. And they think it's just going to come from the trade deal. And again, ask yourself, if the trade deal is inflationary, how is it going to spur consumers and businesses to go borrow a ton of money? Because that's what it's telling. That's what the market's telling you. Hey, as soon as the trade deal goes through, there's going to be so much borrowing that we're going to get ahead of that curve because interest rates are going to go up, up, and up. I'm not saying that it is. I'm saying it's not going to be inflationary. I'm actually more along the lines, I don't think there's going to be a trade deal. I think we're going to have an increase of tariffs on December 15th. But you can see hedge funds completely still positioning for inflation. Now look at the 30-year yields. Now remember, there was a spike in interest rates this week, but look what happened. They took a large increase in their short position, kind of almost tied for going back the last year. So now almost at the second longest position, not counting this cycle. Counting this cycle here, and this cycle being kind of separate, you can see the hedge funds really did increase their long position here. But guess what? There's still not a demand for loans. Lending demand is contracting. That is not inflationary. But they think somehow interest rates can just magically go up. What you would want to see them doing is shorting the dollar, which they're not really doing. But they are really focused. You see, again, the inflation theme from the hedge fund community. They increased their oil longs. And again, if you look at this week's oil data, which I put in the report it's on Facebook, LinkedIn, and on my website, what did we see? We saw a big crude draw, about 4.5 million barrels approximately, but we saw big product draws in gasoline and distillates. So obviously, we know that oil companies raised gas prices, but what happened? Immediately, demand fell. I mean, even last week, holiday season, you think a lot of people were driving. I was totally expecting a big drop in gas inventories, and there was a 3+ million barrel gain. So it says that consumers cannot afford higher gas prices. They are shorting the S&P 500 by a small amount, and are still very long gold. Again, inflation theme, but they've been long gold and it's not going anywhere. At some point, they will get flushed out of those positions because gold should be headed down. I haven't done a long time. I haven't shown the relationship gold and the money multiplier, but one of these days I'll get around to doing that again. They're long tech stocks, and for the first time in ages, slightly long small caps. But look at the dollar. They're long the dollar. See, if you want inflation, you want a weak currency. So now they are reducing their dollar longs, but you think they'd be net dollar short. I'm not saying their position makes sense. And looking from volatility, this is what you see as price fluctuation. So when volatility is low, stock prices tend to make small incremental increases. So they are now the second shortest position in volatility in the history of the VIX ever in the futures market. So very short volatility, meaning usually volatility spikes at some point because everybody's on the wrong side of the market. And until volatility gets back up to where the speculators are long, the stock when it gets there, stock prices will unwind. That's usually how that works. So we'll switch over to here and take a quick look at Treasury yields. The S&P 500 filled its overnight gap from the night before today and then dipped a little bit. Again, investors just so bullish. They're looking here to buy the dip. Looking at the volatility index, kind of unwound its move from yesterday, with still volatility's ticking higher. Let's take a look at 30-year Treasury yields because they're really leading the curve. They are leading. When I say leading the curve, I mean they are leading 10, 7, 5, 3, 2 so far yields. So whatever right now direction 30 years are moving, we know the rest of the curve is likely headed that direction. So 30-year yields. Now this is not the closing value because for whatever reason this program, when it comes to yields, always closes out, I think, 30 minutes early from the actual market close. But nevertheless, 30-year yields close below their 150-day moving average today. And you see these two purple lines, which is a level, and I know many of you have seen this, but it's worth going back to 2016. And you can see right here in 2016, this was an area what's called support, meaning prices or yields found support here. They were not going to go any lower. But right now, support is becoming resistance. And so what that means is when yields, or when price of a security or yields in this case pass through a zone. So here it passed through support and it came up and passed through resistance, and this was acting as if nothing was going on here. But when it came back up at this point, this zone became a level of support, meaning yields were now bouncing off this. And this meant that sellers were willing to sell bonds at this level. And it came through support briefly, but support held because it just kind of shot right back up through here. And then it came back down again through support. And when you break a resistance level, depending on what direction you're going, support can become resistance and resistance can become support. So it crashed through support again, and it started to look like it was forming resistance. See, it got up here and buyers came in. It got up here and buyers came in. Again, it's key. Works when you think about yield, it works opposite the way a stock does, because you have to buy bonds to get interest rates to go down. And it popped through resistance, and then it crashed back down yesterday. And then today, sellers came in and sold bonds up into, again, was support and is now resistance. And if this holds, which it should, because all the, you have payroll data, lending data, everything's saying that this is indeed what it is, and this is a level of resistance. What it implies is the next thing yield should do is, once this is confirmed that it's thou shall not pass, is a retest of the all-time low. So that is what we should expect. And with that, we're going to wrap up. I'll see you on Friday for a weekly economic update. I've got some really interesting stuff, a whole bunch of charts for you to take a look at. Again, I'm Steve Van Metre. Thanks for watching. Bye now.